I don't know where in the US these days $500,000 is going to set your family up for life, and they're going to be able to maintain their lifestyle.
Hey, look at it. If the market returns 12% a year, and Dave Ramsey says you could put it in a mutual fund and make 12% a year, well, look at the magic of compound interest. And I just think that kind of thinking of like, I can eke out a few more dollars if everything works out in the market by the time I'm 65 is so destructive, and is part of the reason why we hammer that model so hard.
Quite frankly, most people are just scared of running out of money, because once you're 80 and you have nothing left, it's tough to find a job and go back to work at that point.
All right, hey, welcome back to Remnant Finance. We've got a recurring guest here, my buddy Travis McBride. Welcome back to the podcast, man.
Hey, thanks, Hans. I think this is number 2 or 3, so good to be back. And
this is number 3. We did,
yes.
We did. The last one was annuities, and that's what we're going to be kind of covering today. But you've got some big news in your life that is pertinent to the life insurance discussion, right? In the last couple months since we talked.
Yeah, my wife and I had a son on May 15th, and he's so going on 9 weeks. We're not getting much sleep, so if I ramble on, or you're watching live and I have bags under my eyes, that's the reason why here. My brain's operating at like 75%.
Well, they should. I mean, if anyone's listening to us, they should be used to it by now, because pretty much the entire time we've been doing this podcast, which is we just hit the 2-year mark, and I've had a baby that whole time. So, I mean, lately, obviously, at this point at age 2, it's a lot better. But for the first year or so of the podcast, our daughter was not sleeping great, and we were right where you are. But just before we get into annuities, has this shift? I mean, you're in the life insurance space, right? And like, we talk so much about strategy, cash value, policy loan. I mean, at least we do. On the IBC side, we talk about how we use this as a living asset. You think a lot about retirement, cash flow, like almost every conversation we have is anchored in what we're doing while we're alive.
Yeah.
But of course, at the end of it, especially with life insurance, it is like it ultimately, and annuities, they anchor on the science of mortality, the statistics around death. And so it forces you to reckon with and think a lot more about death. And even though like our prior profession, right, flying helicopters for the Navy, obviously like that kind of field, statistically, we should be thinking about our passing. But of course we don't, right? We're in our young guys in our 20s, like, I'm not going to die, even though we all know people who have doing our profession. So we were in an inherently dangerous profession relative to most, but it never really crosses our mind. And that's the case for most people. But in this business, you kind of have to think about, so how's that changed having a son now? It's like, has that, that anchor point, that's sort of a theoretical down the road thing that we work the actual math back from to get these living benefits today. Has that changed now that you have more than just, you and your wife, like the next generation's in place?
Yeah, definitely. I mean, from seeing the most recent like tragic passing of someone who's young or whatever, and the family sets up, or just someone in the community, and the news has like a link to the GoFundMe too. Like now having a son, looking at him and being like, well, I'm 37, he's 9 weeks. I got to stay dangerous and be able to be the man of the house for at least the next 18 years, so should I have, in and out double, or should I, make a chicken breast and some veggies for dinner, I'm kind of like, choosing the path that I think is best for him versus the, what tastes the best, and trying to get those extra workouts and I want to be around for the long haul for him, man. So yeah, it's kind of funny you mentioned that, because those are little things I think about every day.
Yeah, it really re-anchors the importance of when you're gone, whether that's in hopefully 40, 50 years, or whether that's in, 1 year. We just never know. And the older you get, obviously, like statistics, the law of large numbers and statistics hold very true. And it seems like I can confirm that every year that passes, it's a few more people I know that die. It's still dying very early, but it's happening, and it's going to continue to happen at an increased pace. Obviously, like that's the most intuitive thing I've probably ever said, that every that passes, we're going to know more people statistically that pass early. But it just changes how you frame things, because so much of what we talk about retirement is like, why do we want to enjoy retirement? Well, we want to have that time with our kids. We want to be able to travel and like all the things that we're thinking about. You know,
Yeah.
it just it kind of removes the focus on your current self to this next generation. It's all about taking care of them. The entire business of estate planning. It's like, if we didn't care about our kids, why do we care what kind of, mess we leave behind if we don't have our estate plan buttoned up? But it really is good for for just coming back to that crucial anchor point.
Yeah, for sure. And I think for a lot of the folks listening to this, VGLI, SGLI, you're capped out at 500,000 bucks. You and I were both in a Southern California, high cost of living. Like, you know, I don't know where in the U.S. these days, $500,000 is going to set your family up for life. And they're going to be able to maintain their lifestyle. So whether get insurance through you or me or whoever, please just get something in place in addition to that,
Yeah.
that basic amount. I mean, you know you just don't want your loved ones to have to struggle financially, if you're out of the picture and your ability to make an income's out of the picture.
Yeah, I remember back early on. It's probably the first squadron out here in San Diego where we do the training squadron. But I remember you probably also recall there was the helicopter in the Red Sea, the giant wave, right? That the rogue wave that that tipped an aircraft off of the back of a destroyer or a cruiser into the Red Sea, and both pilots passed. I remember not only did that change a lot of things about how our procedures are done, right? It changed the entire shipboard operations manual. It changed our procedures for how and when we strap down to the back of the ship, et cetera. That changed everything from an operational perspective. But one thing I remember is I was deeply rooted at that time. I was working with a financial advising firm that I think poaches young officers and just try to get them in high load mutual funds and just base only whole life as quick as possible, right? But I remember I was very into that mindset. I remember helping, get people understanding, what I thought was the right way to do things. And I knew what I knew at the time and was subject to those mental limitations. However, I do remember that kind of being my first inkling. It never really took, like the spark never really took. But I remember that one of the pilots, someone who knew him, somehow this became. I learned that the pilot had canceled his SGLI, which is the service group life insurance. That's the half 400,000 at the time. Now it's 500,000 automatic group policy that we're opted into in the military. But you can opt out of it and save yourself like $25 a month. And so I'm positive that I know exactly how that conversation goes. It's like, hey, look at if the market returns 12% a year, and Dave Ramsey says you could put it in a mutual fund and make 12% a year. Well, look at the magic of compound interest. If you put your $28 a month into the market forever, let's look at this mountain of money that you'll have when you die. You might even have more than 400,000 when you die. And so he canceled his SGLI, had no insurance coverage, and I remember hearing about it was like a very hard to watch funeral, and I wasn't there, but it was on the base while we were in training. And like the mom is left with nothing. And I remember, and I don't remember exactly how I knew this, whether it was a friend of a friend, but I just remember the GoFundMe or whatever the effort was. There's a kind of a base wide donation effort. But I always thought back to that family whenever I thought about SGLI. Like that's the first thing that's like the mental association. And I just think like that kind of thinking of like I can eke out a few more dollars if everything works out in the market by the time I'm 65 is so destructive, and is part of the reason why we hammer that model so hard. That's kind of gets into what we're going to talk about today a little bit, but like the value of certainty versus the speculation of quote compound interest, which doesn't exist in the actual stock market as pitched by Ramsey, et cetera. But like just that always stands out as such a like a misplaced priorities. And now that like thinking through with kids, it's like that decision is unfathomable to me now. But I wish that kind of that red flag that popped up when I heard that story had taken hold, because I spent another 10 years still only having SGLI and thinking that was sufficient. So it never really took hold, but I wish it had. And that's just such a heartbreaking story, and unfortunately common, because still to this day I can name 3 people this year who have died in their 30s and 40s, left children behind, and as far as I know, did not leave life insurance behind. It's like it's still going to keep happening. So,
And I mean that 500K is if you cap it out, right? Like I think
right.
most most people don't have it capped out. So yeah, tough stuff, man. But yeah, I think we're going to talk a little bit about annuities today. And for
Yeah.
folks who don't know what annuity is, maybe you've heard, you've probably heard it on a commercial before. But an annuity is basically, at its root structure, the most simple concept is basically the inverse of a life insurance policy, right? A life insurance policy, you pay a small premium, and at the end, your beneficiaries get a large death benefit, right? An annuity is basically the opposite. In a lot of cases, you pay a lump sum premium initially, and then you convert that into a smaller guaranteed income stream for life. Okay, um, and it's guaranteed for life so long as you're fogging a mirror, the insurance company will continue paying out that preset guaranteed income amount, okay, based off of your initial premium. And there's some factors that go into how much you get on the front end, your age, how long you kind of defer. But if this is kind of confusing, we're all somewhat familiar with annuity constructs. Social Security is an annuity, and we all pay into that, right? Everybody who's making a W-2 out there is paying into it. And basically, the longer you defer Social Security, the higher the income amount is. But you're kind of taking that gamble of like, well, if I defer and defer and defer, and I pass away early, well, am I going to get more or less income over the course of my life? Yeah. So, anyways, um,
One example that we talked about this on our last annuity episode, but you actually kind of helped me understand the power of this was in discussing a VA claim, right? Every military member is forced to go through the process of filing a disability claim with the VA. And so if you were to get 100% disability with the VA, that's around $4,000 a month tax free, right? And disability, according to the VA, is not disability as far as we think of what that actually means, right? But that aside, you're like, hey, if you try to get 100% disability and you get 4,000 a month, that's tax free income. You said, hey, I ran the numbers at 35 to get $4,000 a month tax free income. What you would need in an annuity is about $2.5 million. If you came up with $2.5 million and gave that to an insurance company, they might say, we will give you an annuity, and now that's going to be taxable, right? Or at least part of it is. And so to get the net effect of what you get with 100% VA disability, you would need to come up with around $2.5 million for them to say, hey, based on your age, based on the mortality chart, your life expectancy, we will pay you every month for the rest of your life $4,000 after tax. And so if it's taxable, you might need more than that. Maybe you need 5,000, maybe you need 4,300, but whatever that number is, that example kind of helped me think through like, okay, imagine you had $2.5 million sitting in the bank and you could do different things with it. Well, one of the things you could do with it is you could guarantee that for the rest of your life, you'll get $4,000 a month, kind of like the lotto winner, right? Do you take the lump sum right now, or do you take, the installment payment, or even with your death benefit from your policy? If I have say a $2.5 million death benefit, when I pass, my wife could take that as a lump sum, or she could say to the company, turn this into a monthly income stream for me for the rest of my life. And they would do the same thing I just discussed. Based on your age, based on the mortality, here's how much we would pay you for the rest of your life. And so it's just cool to think about, like, if you in that example, if you understand, if you're applying for a VA disability claim and you get 100%, it's as if you had $2.5 million in an account, and it's as if you transfer that to the annuity or to the insurance company. And then now they said, okay, as long as you're alive, $4,000 a month after tax. It's very powerful to set that floor. Now you could never go below 4,000 a month, right? Add on your VA or your pension if you're military and you do 20 years. Add on your Social Security. Like, the idea of the floor that you're setting monthly gives you a lot of flexibility. The higher that floor is, the less you need to withdraw. And exactly what we're going to get into today. But it's a very powerful concept when you understand the power of certainty and guarantees and monthly income.
Yeah, for sure. And we'll kind of cover some of the basics of annuities, where they fit in the marketplace, and kind of cover some of the other options that maybe money managers preach as gospel versus annuities, and why and where annuities might make sense in your portfolio.
We probably should have done that front, but can you just give a little background of where you work, what you do, what your field is, what exclusive BGA is? Because obviously we can see the email address here, but where are you working right now, and what is your role in this? Just
Yeah.
give
So
people context.
before we get into it, for the folks out there, exclusive BGA is a boutique general agency. What does that mean? I work with money managers. I work with other insurance professionals, really just to provide access to the entire marketplace of life insurance, annuity, long-term care, and disability insurance. And for a lot of folks I work with, like similar to you, Hans, you have your kind of core, your core concept, and there's other products that and other insurance strategies that kind of go hand in hand with your core concepts, and I look to just bring those to you, get them on your menu, so that you could provide a more comprehensive, holistic, service for your folks. And I think, so all that being said, yeah, I make transacting insurance business super simple and easy for insurance and financial professionals.
Yeah, and if you are an advisor listening, like one of my friends and peers in my niche in the IBC world asked if I knew anybody that does annuities, because I'm not trying to focus and be a specialist on annuities, and he's not either. And so our now mutual friend Sean King reached out to you, or like I set you guys up to have a conversation. You've done his podcast, and now if he has clients that need annuities, or he just wants to see, hey, what's the best across the entire marketplace, I don't want to try to become fluent and have be ability to scrape the entire annuity marketplace. And so that's where you come in. So if you are an advisor listening and you want to, intro to Travis, he's got the email there. You can just reach out to me and I'll link you guys up. But it's a great service for us as advisors to get tapped into the entirety of the annuity space. And so just a plug for any advisors out there listening.
Yeah, and I'm more than happy to talk to anybody out there. I might not be a good fit for you, or you vice versa, but I'm happy to kind of point you in the right direction. What we don't want to happen is your clients to be engaged by the cousin at whatever company, annuity company, and get sold something on the golf course that they don't really understand, that doesn't kind of work in concert with the rest of the portfolio, right? And we see it so often that vice, the entire orchestra playing in one room together. You have the trumpet over in the the guest bedroom, and the clarinet, and it's all out of sync. So looking to kind of bring that full service insurance capability to your fingertips, and I do all the paperwork, and make it make transacting super easy.
Yep.
But all that being said, getting into the annuity stuff here, like we said, annuities, and I have for those of you who are tuning in, watching, I have a quick slide here to kind of keep me on track here. Annuities have been around for a very long time, right? I think they trace their roots all the way back to ancient Roman times, where Roman soldiers were paid an annua upon retirement, where they could live a dignified life and continue to collect a paycheck after they reached a certain milestone. So you're kind of your most basic form of a pension. Okay. Now there's a lot of varieties out there today that do a lot of things, but what we're focusing on today is just annuities that provide fully guaranteed lifetime income. Okay. And why is this becoming more and more important? Well, back in the 50s and 60s, when companies provided pensions, they only really had to, the average life expectancy was like 9 or 10 years after retirement age. Well, people are living way longer than that. Average life expectancy is now mid 80s for a 65-year-old guy. I want to say it was 84 and 86 for a female, and those are for men and women who are around age 65 today. So folks are living longer and longer. Companies don't really offer pensions anymore, and a lot of folks are just contributing to a 401k. relying on their own planning to, you know, keep their assets lasting through their lifetime. And, quite frankly, most people are just scared of running out of money. Um,
Yeah.
because once you're 80 and you have nothing left, it's tough to find a job and go back to work at that point, right? So retirement
It's also
planning.
tough to get an annuity at that point too, right? If you kind of miss this window, if you're 75, if you're 70, like it gets tougher to get an annuity, or at least the value can, depending on, like, obviously we're talking about lifespan here. So it's not like you're underwritten the same way you are for insurance, correct? But at what age what's a sweet spot age for getting into annuities?
I would say, near retirees or people who have retired within the past, 10, 12 years. So anywhere from
Okay.
like 50 to, mid 70s.
Real quick on that, let's say you're 75. Can, obviously, like, you're effectively uninsurable, or I mean, if you are insurable, I mean, it, like, at a certain age, insurability gets prohibitively expensive, and the value of what we can do with the policy declines. But it's not quite the same with annuities, right? Like, what is the,
No,
because obviously it's kind of the inverse there. You have less time frame, and so perhaps you could get more. Or what does the underwriting process for annuities look like?
there's no medical
Okay.
underwriting. It's purely
Okay.
based off of age. So,
Okay.
that's the beauty of it, right? If you are someone who, has assets, you have an assumption that you have longevity in your DNA. Mom and dad, brothers and sisters have lasted a long time. Annuities are probably a pretty good, solution to at least consider for your portfolio. And
Okay.
we'll kind of get into the nuts and bolts of why here. But in the marketplace today, right? You have your typical financial advisor. You have your insurance only guys, and full disclosure, right? I make a small commission from placing folks in an annuity, right? Well, a lot of advisors out there, they put food on their table by charging a 1% fee on assets under management. So, with that being considered, a lot of advisors will, and not a lot, but some advisors will say, oh, annuities are bad. Don't buy an annuity, right? Well, why? Because any dollar leaving their assets under management, like you talked about earlier with the life insurance example, and that poor guy not buying SGLI, any dollar leaving their assets under management is a dollar that they don't get to charge their 1% fee on, right? So, you have this kind of chasm in the marketplace where, managed funds, and those managers, really don't like annuities because, it goes against their profit model, right? And then on the annuity side of the house, you have a lot of folks who are just like, oh, put everything you can into annuity. I don't think that is, I think a more nuanced approach is probably, the best approach here, because there are some limitations and drawbacks to both. But I think, by having some liquidity in your, in your 401k or IRA or whatever that is, and then also kind of meeting your baseline needs via an annuity is the approach that probably is best for most people.
Yeah, clearly you don't want fixed products. I mean, there's the fact that inflation exists and is going to continue. Like, you don't want an entire portfolio of fixed assets, even though I would feel a lot more comfortable with a healthy chunk of guaranteed income. It allows me a lot more flexibility, and it allows me, and we're going to get into this, I'm sure, but it allows me to actually feel comfortable to keep my compounding curve in place, right? Right when it's getting most efficient, that's the last time I want to draw down. And so this idea that always just strikes me as preposterous is that we understand the, like, on one hand, we talk about the power of compounding, and we want to look at this curve, and we want to see this compounding curve and how epic it is down the road, right? You're 35 now, you're going to see this epic compounding curve, and we'll all look at a chart of Warren Buffett, like his net worth at 65 versus right now was a tiny fraction of what it is currently because of, it's like, we'll cite all of the power of compounding, even though, again, it doesn't exist in the market, right? That's capital gains, that's appreciation of assets, but that's not compound interest, but by definition. But regardless, like, we'll see this curve, and then we'll say, okay, but once you hit retirement age, we're gonna just take you on the off ramp from this epic curve that we're seeing here, right as it's most powerful, and we're going to dial that back because you can't afford to lose anything because you need to be withdrawing from this pile of money. And it's like I don't want to get off that compounding curve. If this is what you say it's going to do, it's going to just go up and to the right and just hockey stick. Like, well, the last point where I want to be dialing myself down on there is when it's the most efficient, right? So I want the flexibility to do that.
Yeah. And yeah, I think you hit the nail on the head. But so what is that off ramp, and what does that kind of look like? Well, in the managed money environment, advisors will say, hey, well, we're going to utilize the 4% safe withdrawal rate, right? And what does that mean? Well, that means as long as you don't withdraw more than 4% of your portfolio a year, then that portfolio should be able to withstand the ups and downs of the market and not run out prior to you dying, right? And leave you without anything while you're still alive. It's an imperfect benchmark though, and so why? Well, one, it's not fully guaranteed. It's dependent on the markets playing nice here, and I wanted to show you a quick little sequence of return risk. But the biggest problem here is sequence of return risk and asset depletion while you're still alive, right? So again, 4% safe withdrawal rate, it should work so that you don't run out of money. But sequence of return risk is basically a risk that says the order of returns in any given period matters more than how much you're withdrawing. And kind of what do I mean here? If we look back, at, let's go, 1975 to a 30-year period here, and this isn't my calculator. This is from SafeMoney.com, but 1975 to 2005, a 30-year span here. We plug in the 1% asset management fee. You can see that we're going to start with $1 million. And our annual withdrawal is going to be $40,000, 4%. You can see that, hey, in this case, right, we utilize a 4% withdrawal rate. We hit a pretty solid market at the end of this 30-year period. We left $5.3 million on the table. However, if we reversed the sequence here, we'd have only $4.4 million. So we can shuffle this and just mix up the same returns, but we can mix up the order, and you can see how the final amounts change dramatically here each time we shuffle. Now let's go to a new 30-year period here, right? 1980 to 2010. And you can see.
Wow. You cost yourself $2 million by switching the order. And I've seen time snippets before on this, and if you're just listening, is on safemoney.com. I've seen time snippets before where in this 30-year period you have X number of millions of dollars in the order of that the years happened. But if you reverse those orders, your average is still the same. So you could still say we had an average rate of return because the 30 data points are identical. But then you run out of money by, say, year 12, and if you just reverse the order, right? And so it's a total unknowable, market phenomenon here.
Now let's compare that to what a 65-year-old could get in the annuity marketplace. Vice implementing the 4% withdrawal rate, here we stay pretty safe. Well, in the annuity marketplace, we could take that same starting balance, $1 million, and we could pull a fully guaranteed $77,000 per year. Okay. Now let's plug that in here and see what happens. Okay. And actually, we're going to turn this management fee off to make it a little bit more fair, right? But now, if we were to match the income that we could go get in the annuity marketplace over the same 30-year period, we would run out of money, basically in the last year here. If we, reverse the sequence, our final balance is depleted. whoops, our final balance is depleted here in
Yeah.
1994. It only lasts 14 years here. Shuffle.
Yeah.
We pass away at, with 153,000. Hey, we shuffle the order again. Look, this case we, leave on $3 million. But the entire time we're worried. We're worried. We see the market taking. We see the market volatility. We're worried about running out of money. We're not sure. If we should take the annual withdrawal or dial it back or what we need to do, versus in the annuity marketplace, well, we could take that $77,000 here for a 65-year-old starting year one, and there's zero concern about market volatility. There's zero concern about having to pass away within 30 years here to make sure that we don't run out of money. If you live to 125 years old, the insurance company is going to continue cutting you that check every single year, so long as you're fogging a mirror. So, anyways, I think
and that's a really interesting. I've never seen it where you could shuffle it. I've seen this demonstrated. Here's a 30-year snippet, and then here's it in reverse, and here's the difference. But like by hitting that shuffle, it's the exact same 30 data points. The average rate of return on all these is the same, but you went from fully depleted at 14 years up to leaving $2.2 million, and so you're just throwing a dart here, and this is not a sound strategy. I don't care what over 40 or over every instance. The way they came up with the 4% rule when they did the Trinity study was if you withdraw 4%, and I can't remember exactly what the margin of error was, but it was like if you withdraw 4% a year in every snippet of the market, 90% of the time you would have had money left over when you passed, right? And it's like, well, okay, well, that's if I live 30 years. What if I'm in the 10% that didn't outlive it or that didn't have any money left? Like, so now there's all this debate about, well, is it 3.5% or is it 5%? Because the market's been ripping for the last 10 years. So to me, it's kind of a stupid debate. And it's just a financial checkers discussion. And I think that adding this element here makes it so much more robust. And if you actually understand this, I don't see how there's a counter to this. I mean, I know there's obviously a huge industry that's trying to get you to not look at your finances this way, and I think I know why, because I'm going through the Series 65 and I'm going through these licensing exams right now, and I understand why the knowledge around insurance and annuities is so atrocious in the financial planning world is because it's almost fully neglected in the preparatory coursework and everything. Like it's like it views these as like these are afterthoughts and these are just make a quick decision on insurance. Do you want it temporary for cheaper or do you want it permanent for longer? And that's the entirety of it. And so it makes sense why like policy loan, understanding what cash value is 0% of the Series 65, which is what you need to give licensed financial advice, to start an RIA, registered investment advisory, to be an IAR, an investment advisory representative. Like, in order to do that, you need zero working knowledge of life insurance or annuities. 0% to pass those exams. And I can promise that's the case because I'm wrapping up those exams right now. So it's just, I understand why there is a entire and you mentioned the compensation structure. It's like we hear that all the time. When people challenge the way that we structure a policy or that we do policies at all. It's like, oh, you're just trying to get a check. It's like, do you think that if this was where the money is in life insurance and annuities, if you think that's where the money was, don't you think the entire industry would be piling in here, right? No, they're piling into assets under management because it is so much more appealing and you make so much more money doing assets under management. It's like, all that to say, the incentives align and it's understandable why there's so little knowledge and why this method that you build up this pile of money and use the 4% withdrawal rate, that fits perfectly into the goals of a financial planning firm. If you do that, it is the best case scenario for the firms that sit on that money. And I fully understand why the system is the way it is, but I challenge you to think through it without the lens that you've heard and from an advisor who has no requirement to know anything about insurance or annuities, and look at these numbers here. Like when you understand the power of certainty, it changes everything.
Yeah, absolutely. And again,
that's my little diatribe.
No, I love it. And I think, kind of just zooming out, yeah, like you said, every dollar that leaves an advisor's AUM that goes into an insurance product is a dollar they can't charge their 1% fee on. So, you know, and not to say there's not a lot of good advisors out there, but
Hmm.
there's also a lot of folks who preach, hey, annuities are bad, life insurance is bad, and we're here to kind of tell you, it's not. These things have their time and place, and having a fully guaranteed income stream where you could, leverage the same amount of capital and pull out almost damn near twice the amount of income on a fully guaranteed basis is a powerful tool. And I don't, and the annuity, chassis is the only thing that does that in the marketplace. And that's why I think, having a nuanced approach, having annuities in the conversation or part of your portfolio, along with, your 401k or IRA or whatever it might be, is something you at least should consider. And if you don't understand how they work, or you're interested, happy to kind of build you something out customized. But again, I think just solely looking at the 4% rule withdrawal rate, solely looking at annuities is the wrong answer. And if you have someone who's who's kind of that all or nothing, you might want to get a second opinion.
Yeah, absolutely. Always come back to trade-offs too when you're doing these analysis. There's nothing that doesn't have a trade-off. You
Yeah.
don't get the annuity with you don't in that example that you gave there with the $77,000 a year of guaranteed contractual income for the rest of your life. That's phenomenal. Who doesn't want that? But the trade-off is you need to put the capital in up front. Whole life insurance, all of the values we talk about. Anybody listen to our podcast, I think at this point doesn't really need to be convinced on the value, the power of cash value as an asset and what it can do for you when you understand the policy loan tool, how you can leverage, etc. Right? But that comes with a trade-off. The trade-off is you need upfront capital, not as much as an annuity, right? You're paying this over time, but there is that upfront friction where it takes a couple years before you're really getting a dollar of cash value for every dollar you put in the policy. Now that might only be 3 or 4 years, contrary to the typical base only policy, but there is a trade-off there. There's a trade, and this is the problem is the I'll say the market, the investment world, the financial world and the financial consumer world are dialed in on the trade-offs of life insurance and annuities. They are hypercritical of the trade-offs of life insurance and annuities, and I yes, there are, and you should be aware of them. There's a complete lack of analysis of the trade-offs in, say, a Roth IRA, in a 401k, right? Like it's like focus on the trade-offs here and let's not even pretend there are trade-offs in the 401k. That's how it's approached, and that's how I've seen it in everything I'm studying. That's how I've heard it in every conversation I've had with financial planners for the most part. And so the trade-offs is like, yeah, what do you get with a Roth IRA? Well, you get tax favorable treatment under strict conditions. The trade-offs are the fact that you're tied up for decades and decades. The trade-offs are once you hit a certain age, you're going to have to start withdrawing it, right? Well, not with the Roth IRA. There's no RMDs, but like there's all these trade-offs in the tax code. There is a lot of things that you need to know when you're going into these products, and so look at everything from the trade-off lens, not just what you're told to focus on with the trade-offs here.
Yeah. Yeah, absolutely. And I think we touched, kind of beat this up enough, but sequence of return risk, again, it's not necessarily, it's the order in which those returns could really hurt you. You could have the same, average rate of return over 30 years, but if we flip that order and you catch a bad sequence early on, while you're withdrawing assets, that portfolio may never have enough time to recover. And just due to you being in retirement and kind of having the hard backstop of life there, and you might be permanently, it might be permanently impaired where you run out of money and it's depleted prior to you passing away, which is the biggest fear for someone who's worked and earmarked that capital to provide retirement income, right? Again, annuities solve for that volatility. You just convert a lump sum, or in some cases, flexible payments over a period of time into a guaranteed lifetime income stream. You get rid of that sequence of return risk. You meet your baseline income for life. And also, what does that do to the other assets in the portfolio? Well, now you don't have to be as strict with the assets in your 401k. If you know that you're never going to run out of money, that gives you the kind of flexibility and the freedom to, maybe take some shots or, continue to put a little bit more risk into that than you had before, where you're kind of hamstringed to be super conservative. Why do annuities offer more, a higher payout rate than, your 4% withdrawal rate? Well, again, there's some liquidity drawbacks in the annuity world too, but, versus you just funding your own retirement where, your returns are hopefully all interest and a little bit of principal, right? In the annuity world, you get return of interest, principal, and you also have what are called mortality credits, kind of a third form of return. What are mortality credits? Well, basically, an insurance company, if you or I go to an insurance company, they can't accurately predict when, exactly we're going to pass away, right? But when we pool in thousands of people via the law of large numbers, statistical analysis, these insurance companies can predict with an extremely precise degree of accuracy when the average lifespan will be. And because of that, they're actually able to front load these annuity products and give you some of those returns early because they know via the law of large numbers that, a certain percentage of people will pass away, at the average age of life expectancy, that a certain, standard of people will pass away within that first standard deviation. And because of that, they're able to, front load those returns to you. And that's what's called mortality credits.
Yeah. And there's a reason that insurance companies do annuities, right? For people that aren't super familiar with them, it's the same actuarial tables. And so the companies that have actuaries on staff are the ones that provide these annuity products because it's the same math, almost in inverse and for almost inverse function. But again, it ties in well with like an overall sort of holistic approach to how we look at this.
Yeah, and I think we kind of beat the dead horse here, but the math of higher payouts, kind of just touched on this, but the portfolio approach hopes that you don't outlive your assets. You have to, withdraw a conservative amount, leave more in the portfolio, and again, we touched on some of the, the drawbacks of that, some of the, incentives that align with your own interests because you're going to have liquidity there, but sometimes those incentives don't align with your interests. They align with the, profit model of the person, who may be giving you that advice. And same thing over here on the annuity side, right? But, they fill a gap to provide fully guaranteed income for life that no other product in the, financial planning landscape, delivers.
Yeah. I think that smartmoney.com, that calculator there is, and I'm familiar with the order that you take these years, but I have never seen it shuffled like that. And just clicking through shuffle and seeing the wild variations, this is not where you want enormous variations, anywhere from leaving 2.5 million to zero in, being depleted in 14 years. Like that's the range of outcome with the same exact data set, just depending on what order you put these in. That I think to me, that was worth the entire conversation, was just to see that shuffle function right there. I have not seen that, and that's awesome.
Yeah, and another thing to be said is, right, like, if you're gonna stick to the 4% rule, right, over the course of 30 years, your cumulative income will be, $1.2 million. Again, we're speaking in generalities here. This is not a perfect, analysis here, but it serves to make a point, right? $1.2 million. Okay, well that's great. You left on a bunch of money that you didn't get to enjoy because you're concerned about market risk. Whereas if we pull 77 grand out every single year, we've lived off of, almost double over the same 30-year time frame, without concern of market risk, without concern of our assets being depleted. So that's kind of the major point to drive home here. I think they have their time, they have their place. If you're talking to someone who says they don't, probably worth it to get a second opinion.
Yeah. Yeah. And these kind of conversations are things that I think that you owe it to yourself to like pull every thread and just make sure, even if this strategy doesn't work for you, we've got, if you're 35 years old right now, it would not be you probably wouldn't be advised to get into an annuity, right? It just probably doesn't make sense right now. But if you just understand the power of that concept and think through that pension idea or the VA disability claim, for those in the military or Social Security, like the power of certainty is enormous and should not be understated when you're having that financial advisory discussion. And so, like you said, if it's not being mentioned or if it's just totally a blanket no, that should raise some red flags for you.
Yeah, and now kind of talking about those high payouts, right? How do the annuity companies structure these payouts? Well, one, it comes down to age, but also the annuity payouts are tied to the 10-year Treasury yield at the time of purchase, and I really want to foot stomp that. Why is that important? Well, think about where the 10-year Treasury is right now. I want to say it's 4.4 something, right?
Yeah.
Somewhere around there today. Well, we just came out of a rate environment where the 10-year Treasury yield was the lowest it's ever been. A lot of folks bought annuities during that period of time. Well, when the payouts linked to bottom of the barrel interest rate at the time of purchase, the contractual guarantees are also linked to that. So the long story short, if you, or probably more applicable, if your parents bought an annuity within the last like 7 to or maybe sooner than that, probably like 5 to 17, 18 years, it's worth it to get that annuity reviewed if they haven't started the income, because in a lot of cases we can execute what's called a 1035 insurance exchange and swap out a brand new shiny product with a much higher payout rate for a product that is just not competitive versus what's out there today. In a lot of cases, and every day I go through and do annuity reviews. Grandma's sitting on a old variable annuity she bought in early 2000s, and the guaranteed payout rate is $27,000 a year, and we could just transfer it to a new company and get her a $34,000 a year guaranteed payout. Hey, how would you like an extra $7,000 for the next 20 years of your remaining life expectancy for zero out of pocket? And they're like,
right. That's the thing, and that's the kind of the case that you've walked me through, where it's like getting this exchange to a higher payout policy is very possible right now if you've bought during the time frame you mentioned, and that's the big foot stomper. They're like, out of pocket for you, there's no increase, and so if there's even a 2% chance that you could improve your situation greatly by having a 30-minute phone call, I don't understand why anyone wouldn't, but I know that most won't, even though that could be sitting on the table. So if you do have an annuity, it's worth getting on Travis's calendar and just seeing if something can be done. And if not, at least you follow that trail to the end to realize, all right, you're in the best spot you can be. But you should seek to improve that if you can, especially when it comes with no out-of-pocket costs. I mean, it's a no-brainer.
Yeah, no, happy to, if you have a product that's new or you're not sure how it works, I'm happy to kind of walk you through it, take a look. And, the goal is to make you walk away with the warm and fuzzy that, hey, you're in the best spot possible. Now, if you're not, we're happy to show you options where you can improve it if they exist. But in a lot of cases, like I said, folks bought annuities in low interest rate environments that have low guaranteed payouts, or in a higher interest rate environment, we can just easily swap them over and improve income in a lot of cases. Yeah. So if you think that's you, get on the Hans, I'm on your website. I think there's a link to schedule a call there. So happy to take a look and get you pointed in the right direction.
Yeah, if you go to the services tab on our top menu there, one of the options is, or if you go down that page, one of the options is referral partners, and so we've got you on there. You can watch our prior interviews. You can schedule a link to chat with him, and And I think we have your website listed on there as well. We'll also put your booking link in the show notes just so people can go direct to you and have that conversation and see if it's something that can be improved upon.
Yeah, absolutely. And obviously, if you book a call with me, write in the notes, hey, I'm a client of Hans, so that we can make sure that, we're not just looking at anything in a vacuum, and that, it's going to jive with the rest of your plan as well.
Cool. All right, man. Well, maybe you can go catch a nap.
Yeah.
Kind of try to recover a little bit, but thanks for coming back on, and yeah, appreciate this conversation. Our bread and butter is helping you rethink your thinking, and this is an area where you have just had bad information pummeled into your head. And to be fair, there is a lot of bad practice in the insurance and annuity space, and so a lot of the black eye is deserved, certainly. And I think that if I look at the first whole life product that I had versus what I have now, doesn't even deserve to be called the same product, honestly, because one has the same contractual rights, but is kind of a frail skeleton, and one is like a bodybuilder, and it's like there's not really a comparison other than the fact that they are technically the same product. In the same way, there's a lot of bad annuities out there. There's a lot of people that are in annuity products that they shouldn't have. And so I think understanding that and recognizing that, yeah, the black eye can be deserved, but the marketing you've heard against it, I hope you understand a little bit better now why perhaps there are incentives aligning from the powerful institutions in the financial space for you to not explore this. And the best case is if you just overlook this product entirely and don't pull that thread. So as always, rethink your thinking. Thank you for coming back on. We appreciate it. And hopefully someone can get an improvement of their situation just by listening to this conversation. So
absolutely. Thanks for having me. Great to have been back on. Thanks, Hans.
All right, everyone. Cheers.
See you guys.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.